further ado, I'll
Yeah.
just let Frank from the bank start.
Yeah,
So.
that and a little bit about, I guess, people look at banking and they think, what are those guys looking at? And, hopefully I could give you some insight as to, how we look at things, because that's usually the topic that throws people off. It's, the old adage is, you only lend money to the people that don't need it. And in some respects, there is some truth to that. It's not that, they don't need it, but banks have a risk profile that's pretty narrow. And because of that, the qualifications, while not rigid, are some that the folks that look in credit are pretty adamant that you meet. So what I do, I'm a commercial lender, and my background is doing this in the Pierce County market for longer than I want. I'm living proof that dinosaurs can speak.
Oh, you're just a child.
Oh, I'm not. I almost measure my career in the number of banks that are no longer here that I've worked for, because there are quite a few. I started with Rainier Bank back in the mid-'80s. And I've been in South King County and Pierce County my whole career, and I love it. And one of the things, first thing banking-wise is, from our standpoint, we need to know our market. Pierce County is a very provincial market that, Pierce County businesses and whatnot want to deal with Pierce County bankers and Pierce County employees and residents and whatnot. So, I live in Pierce County and I like working there. One of the hardest things you can do is say, I'm from Seattle. And it's like, get out of here. We don't need you there. But, I've got a nice background in my career in that I've been at the big banks and now I'm at smaller banks. And from the customer standpoint, I think that's important because, I think it's important as much as the banks are looking at the customer finds the right fit in the bank. And, we'll go into that. First thing is on the larger national banks, they've got a lot of good services and they do a lot of things and whatnot, but they do fee you for it. So if you're a customer that deals domestically and doesn't do a lot of wires overseas or ACH transactions or other things that that they have, whether you use them or not, their fee structure is costing you a little bit. So you want to make sure that what you do fits the bank size that you want to work with. And, so national banks also have, I won't say they're not service-oriented, but I think they are more transactional-oriented than a community bank would be. From my standpoint of community banks, the things that make them valuable to the smaller companies, startups, the middle market is that we reside and we are in the market. We know the market. You have people here that make the decisions that know Puyallup versus Tacoma, that know Sumner versus Auburn and South King County. And while you think that's trivial, Thomas and I both worked for a bank that was located in Tacoma. And one of the things that they told us was Puyallup is out of our marketplace. They wanted to be right down the I-5 corridor. And there was a lot of business that we left on the table because the bank was based out of Eugene, Oregon, and just didn't know the market. And so, I think that's important to know. Smaller banks, from what I do, is I think I can take more of an interest in how you do things and why you do things. And the reason we do that is the understanding of such is the more I learn, the more help I can be. You've got your tripod of services, your attorney, your insurance guy, your accountant, and banker. So I guess now it's a chair, not a tripod. But your attorney and your accountant will charge you when you talk to him. Your banker, if he gets to know it, hey, our advice, and it's just advice, is free. And so what we strive to be when we're at the community bank is to become the trusted advisor. We'd like to have Dan be able to say, hey, Frank, I'm thinking about doing this. What do you think? And we can give you an opinion. And it's just an opinion because if we knew how to run the businesses that everyone runs, that's what we'd be doing. So, that's one of the things. But as you approach a bank for money, there are definite things that the customer can do that will basically get the attention of the banker. And it's sort of like a resume when looking for your job. When things are done right or things are done in different ways, we can streamline things. And it comes down to what I'm sure you've all heard of is the 5 C's of credit. And it comes down to, and this is the order I think they should be judged, is character, capacity or the cash flow ability to make your payments. You have the necessary capital, so basically the net worth or the value of the companies or the individuals. Collateral, banks are notorious for wanting to be able to grab whatever it is that's securing their loan. And lastly, the conditions of the economy, the borrower, things of that nature. And, when we look at things, from my standpoint, character is the most important. When you come into a bank, it's, you hear about, let's have a great business plan. Let's do this and do that. And I think the numbers are nice, but that's about the only point I really look at is the numbers, because what I would rather do is discuss it with you. I'd like you to come into the bank and you have an idea of, how much money you need, but not just that number, why you need that much, whether it's the price of an acquisition or it's cash flow because of gaps in payments, and I've got a seasonality issue where I need to cover payroll. So I think the whys are more important than the amounts. I'd like to know, exactly how you determine what your needs are, and if there are other alternatives. Hey, if we're looking at something, is this what you need to get going, or is this kind of a best case scenario, but you'd be able to get by and start with X amount and get going? And so that way, we can have a great discussion, because what your thought might be different from what we ascertain as far as structure. So maybe there's a different way of getting there and getting the same result for you. And we've got bankers are like archers. We've got a quiver of arrows, and there are a whole different things that we can use. And so as we discuss things, you might come in and say, I want to buy a $2 million building to move my company headquarters. And we're looking at that, and everything is going well. And we start thinking, it's like, okay, we've got this building, brand new money, it's conventional loan. We're going to require skin in the game. Your contribution as well as ours, because banks, we're a for-profit industry. That's one of the things that sometimes gets missed, is that we're going to do things, but we need to make a little bit of money on it too. But so you're looking at that. We want money into the game and whatnot, and it's like, well, okay, we've got your business running, you've got all this money coming into our bank. Okay, now how are you going to operate? Now, if you're using all your cash here and you're going to put it into this building, what are we going to do? So, so then maybe the next thing we look at is what can we do? We've got traditional bank financing. Well, let's look at what an SBA loan can do. And so then we sit down and we go, we've got an SBA 504 program that is available to us, and it looks like you meet the qualifications, which are no more than $5 million. Net worths that don't exceed 15. They're pretty stringent and out there, and you meet all that qualification, and we're either creating new jobs or preserving the jobs that are there. So we look at that and we can say, well, Mr. Customer, we've got this program. Front end fee might be a little bit more, but here's where the value is. Instead of coming up with the 25% down that the bank needs, this program only requires you to come up with 10. And the bank is happy. We're going to do a loan for the construction, and when it's done, we're going to take 50% of the loan, and the SBA, bless their heart, will take 40% of it. And not only do you get a lower amount in, you also get, from the SBA portion, at least on 40%, you'll get a 20-year term rate with no repricing or no anything. You get a nice fixed 20-year rate to work with. So, we can look at that. The more we know, the more options we have. And that's why I think, smaller banks like the ones that are locally based in Seattle or basically Washington have some advantages over the big guys because we can
Frank,
provide
let me
service.
throw something out at you.
Okay.
It seems like banks aren't creative. They kind of like do the same thing over and over, but the generation and the world's changing with intellectual properties and stuff like that. I mean, it just doesn't seem like they can ever help. Like,
I think there is help for those types of industries, but I think banking in general is a conservative industry, and it's sort of a monkey see, monkey do kind of thing. So especially smaller banks, we're not going to take usually the risk of trying to figure out how to do intellectual property or other things like that. Bigger banks will figure it out first, and then it'll trickle down. But I think those things are being done. I think like one of the things being looked at now, and it's in the back of everyone's mind, is the marijuana industry. We're in a weird place in Washington because state-wise it's legal. Federally, it's not. And banks are basically based by the federal insurance corporation. And so right now what happens is from a bank that receives those funds, we can't touch anything that has to do with that industry. And it's a growing industry, and you're going to have individuals that are doing well, individuals that aren't. It's going to be a typical industry that we've got to figure out. But what happens now is if you've got a building that you lease and you want to lease to a marijuana store or whatnot, small 10,000 square feet or whatever it might be, we can't touch that building. We can't use it for collateral. We can't do anything unless that person, seems odd. I mean, you would think at the very least we'd be able to maybe discount the cash flows from that section and make it work, but we can't touch it at all. So
and the reason why is because if you potentially foreclose, the government can come in and take the whole
asset, yeah.
entire asset.
And that's why I think that's an industry that I think banks want to do. And I think as more and more states pass that law and becomes federally acceptable, which it should someday, and I'm not an advocate yet either way, that would be another one to look at. But I think banking in general is a little bit conservative, so we're not going to be on the forefront of the industries getting into things. But you'll see banks that are tech companies. Same thing when the tech boom came up. It was like, how do we do that? But now it becomes old road. Folks will do. I've got a customer basically that its offices are in Peru, but its main offices are here, and they basically will do software engineering and whatnot for Disney and other folks off-site because it's cheaper. So, we figure it out, but we're not going to be first and foremost, and somebody takes the risk. But eventually, everything that makes money gets financed. There's a way to figure it out, and that's, the main thing is the incubator is you have startups. Guys are getting out of the military. They're all excited. They want to open up their own business. And what we want to make sure they do is when you come to us is make sure you understand what it is you want to do. It's disheartening, not disheartening, but sometimes you get the gentleman that says, I'm going to make T-shirts. Thomas and I had this. We got this T-shirts. It's going to cost us this amount to make the T-shirt, and with each sale at $15, we're going to make $5 per T-shirt. And it's like, okay, so how long is it going to take to print? How long? We've asked all these questions that they had no idea about. And the lesson that we had to teach them is, it's not profit that usually damages or puts businesses out of business. It's cash flow. It's like, it's great to get from here to here, but the big question is the roadmap in between. How are you going to get there? And so that's the issue with startups. It's difficult. So from that standpoint, it's good to know the numbers, what you want, what your numbers are going to be, put some thought in what you're doing and how you're going to do it, and then, sit down and talk with a banker. And it's not important that you know every answer. If you don't know it, there's no shame in saying, I don't know, let me research that. And, it's not going to be a one-time come in, yes, we can, no, we can't. But one thing that the new business should know is banks are not going to be your first source of funds. It's definitely, they just don't fit the risk profile that banks have. What a bank basically does is we've got a certain risk profile. You've got a business that's starting to do well. A bank will come in and allow you to leverage that business so you can get to the next step.
So with that, in what you just said, so if you're a brand new business, and you have to bootstrap, I know when I was in banking, a lot of startups use personal credit cards. And
Yeah.
the banks got mad because of, why are you using personal credit cards?
Well, it was the only funding they could get.
Exactly.
Right.
But so how do you, are you against personal credit cards to start up business?
Personally?
Yeah.
No, I'm not personally, because if you've got that idea and you want to get it to market and you believe in it, you will take the risks and do it any way you want. But you have to not be willy-nilly and not give some forethought in what you're doing. When you're going to do it with credit cards or something like that, you've got to have an idea of what your limits are. This is credit card, these are the payments. Again, it's a cash flow issue. If I have to pay X amount each month, how much am I going to do that? Or at what point do I go and I seek bank financing? I'm making profit. I've kept the profit in the company. Things are looking strong. Now's the time to do that. And the other thing that's missed from a bank standpoint is if you're going to use credit cards and they're for business purpose, keep those receipts so you can prove that it's for business purposes. It saves us as bankers a ton of time where we can go to programs and say that, because again, we could maybe go to an SBA program of some sort and we can say, well, we've got all this credit card debt we can finance. Well, we don't finance personal credit cards, but here's the backup showing that was used for business. And under those conditions, we can do it. They'll do it. And so that's the one piece. Again, it's important to keep good records. It's important to be very persistent, very stick-to-itive to making sure you manage those records, because the financial aspects of your business could be what puts you in and out. You might be great at building that widget and marketing that widget, but if you don't pay attention to the financial side of the house, you have no idea, what that widget costs, or if this contract makes sense with the margins, or where the errors are going to be. It's just as important, I think, on the other side. It's like the dentist that is great at dentistry but has no idea the finance side of his practice, and a lot of times that's a bad combination moving forward. But let's say you do come into the bank and you've got everything, and I've got the information I need, which is typically, from what I look at, it's 3 years of history, whether it's tax returns, financial statements, and then some information on yourself. What do we do with it? Do we just kind of throw it? That's kind of a question that depends on, again, bank size, the amount of money you're looking to borrow, purpose, because there's an aspect of things now as we get more technologically advanced and whatnot. Everyone's looking for the more streamlined, quicker, easiest way to analyze things. And I think that's, in some respect, harmful for what banks do, because again, when we went over the 5 C's, I look at character as number one. I think technology at times takes that out of the equation. And that is, I feel that's an error in moving forward. But again, I think what banks look at in that, again, being a profit business, is they're looking for a churn of volume. If we get so many of these deals of this size, we realize there's going to be a failure factor of X, and we're willing to do that. And that's
another,
that. Oh.
Well, I was going to say another character when you in the industry, we call it credit scoring.
Yeah, that's what we're talking about, yeah.
Yeah, and the thing is that sometimes when people say, well, I have a bankruptcy, and I don't think I can get a loan. However, I beg to differ on that one too, because if you have a bankruptcy on your credit report, if there's an explanation why you have a bankruptcy, you can make a case. As an example, when I was a banker, there was a guy who had a bankruptcy, but it was a medical thing. His wife had cancer, and he had to file bankruptcy because it was going to ruin his business, it was going to ruin his credit, and I being with a small bank, a regional bank, I wrote it all up and explained why this was happening. They said, well, that kind of makes sense, because he just didn't file just to file because he had a bad business.
Yeah, no, there are definite ways. A medical bankruptcy is definitely a more valid reason. I think now with the advent of the downturn of 2007 or whatever they're going to call it, the Second Great Depression or whatever it is, I think that question has gotten restated to the point where the question is now, have you had any properties repossessed either voluntarily or involuntarily? And that, I think, is more of a testament to, whether you were willing to move forward and fight on, or whether you were giving up. And that's a question that's being asked again. That's not something that can be answered easily, because a lot of folks that I know continued to make payments when things weren't working. They were exhausting every effort they could to go, and they just, it gets to a point where it doesn't make any sense. And if that's the case, from what I do again as a loan officer, my job is to advocate. I would advocate wholeheartedly that this was a situational thing, that the borrower took every avenue to do it. Here's the proof. The situation was such that banks and the FDIC and whoever else put in the rules of what had to be done would add it to the failure. And so, yeah, that's one. But yeah, credit scoring is kind of a new thing, and it's usually on deals that are, depending on banks, 500,000 or less on the big banks. The smaller banks, I think we're targeting 250,000, and that's where you basically fill out an application. You give us the authorization to run a credit report. We look at the credit report. There's a score that's assigned, and if it's above a certain level, the deal is made. If not, it kicks into another batch where an underwriter, someone with human eyes or whatnot, will look at it and make a determination. That's not what I do. What I do is commercial lending is more, I do analysis. I look at your financial numbers, and first thing I do when I get your statement, is I'll go through the financial statement, and I'll look for a trend in revenues, I'll look for a trend in profitability, and I'll look at a trend in retained earnings. Those are the first numbers I'll key on. If, right away, if sales are going down, that's not necessarily a bad thing, but that just spurs me, okay, this is something I have to look into. If the net profit is down, of course, I'm going to look at that. Is it something that, hey, last year we had to redo the floors of our warehouse to a tune of $100,000. That's a one-time expense. I can look at that, and okay, that makes a lot of sense. But if you're looking at trends, I've got one company now that is a bunch of accountants, and we're looking at them, and there's a definite trend in the last 3 years of declining revenues, and it didn't make much sense to me. So when you ask the question, it's like, well, we had a gentleman retire, and he was running this specialized field of accounting. It was forensic accounting, and he's gone, and we've not been able to replace the revenue with the new guy that's there. And we're like, it's unfortunate that your current bank is not working with you, but then again, we look at a risk profile too, and that's one that's difficult for us. And so, we had to move forward and turn them down, but it was because of something like that. But when we look at those numbers, the next step, there's two real critical ones, and you've probably heard these terms before. But we look at working capital. And working capital, especially when we're looking at short-term debt, so lines of credit, things that spin in a year, whatnot. Working capital is real important, and that's basically taking the short-term assets that you have, which typically consist of cash, accounts receivable, and inventory are the ones we focus on, and less the current liabilities, which would be your payables and your current portion of debt. We want to see what that gap is to see how much money you're internally creating to help things run. So that's a critical number for us. And the key on that is positive or negative. There's no real magic number per se. The second thing we look at is a number called, there's various pronunciations, but it's Ebitda, however you want to put it. But basically, it's an acronym that stands for earnings before interest, taxes, depreciation, and amortization. And so, is there a question or?
No, I trade stocks.
So you know exactly, yeah. But that's, how do you pronounce it? I guess it's.
I go by Ebitda.
Ebitda, so do I, but I've heard it so many different ways. But that's a key focus for us because we use that number to calculate debt service coverage because we want to make sure, the key number with a bank is we want to make sure for every dollar of debt that you're earning or being able to create $1.20 is usually it's a 120 in revenue to support it. I've seen it go, depending on the industry, and as low as 1 to 1. But it's got to be 1 to 1 or over, and that's what we calculate. And why it's that number for those that don't use it is there are certain expenses that are on your income statement that are non-cash, and that it typically would be depreciation and amortization. So it nets down the net profit. But we realize it's a non-cash event, so we add that back to that number so we can factor that in. Additionally, the interest expense is typically a number that is required. We add that back in because we're going to net it out with your payments. Typically, we do it their principal and interest payments. We figure we've got to put the interest back so we can calculate that right. So that is a key figure in us calculating EBITDA. So we look at that, and typically we'll take, if we have a good financial statement, we'll take your current portion of long-term debt from the previous year, calculate it. If it comes out positive, move forward. And to me, that's the key one moving forward because it shows, okay, your business is operating in a way that this new debt you want to add has been supported, and we have a good feel that moving forward you can. And intuitively, if you think of banking, it really makes no sense where you're taking past history to decide future performance. And that doesn't always add up, but it's the best indicator we have. So it's not perfect or whatnot. And so I would take those numbers, move forward. Additionally, sometimes there is another number that we look at, and it's called leverage. Basically, it's your total liability compared to the earnings of your company, and where that comes into play. And I'm sure the folks that are self-employed can vouch for that, is that self-employed businesses at times have difficulty obtaining bank financing because of that leverage number itself, because I think at times the businesses are running into diametrically opposed purposes. A lot of self-employed businesses operate to the point where they're trying to minimize taxes. So at that standpoint, they're pulling a lot of money out of the company. Well, as a bank, when we do a debt service coverage and that money's coming out of the company, we're not able to meet that hurdle. So sometimes for the sole owner or the businessman, the closely held owner, sub-S or whatnot, you have to decide what is the focus at this stage of your business, whether it's to be bankable so you can get the leverage money to grow, or if it's still to minimize taxes, because it's a tough road to do both from a traditional banking standpoint because of, again, the risk profile that we look at.
And also it goes back to you, to the bank that you want to deal with. As an example, when we used to bank medical, a lot of doctors take a lot of their money out is their distribution.
Mm-hmm.
And when you take a look at the balance sheet, there's no retained earnings, a negative retained, the retained earnings or equity is kind of low. Then we look at it and it goes, well, he's a brain surgeon, he deserves to take all his money out because
You don't deserve to, but it,
See,
He's got to-
go back.
The numbers don't work for the bank.
Yeah.
the numbers, and in that case, you look at it, and and Thomas's point is right. You do look at industries because you can say, a rule of thumb is, if you've got liabilities 3 times your value of your company or your equity, that's probably the ceiling that banks look at. But there are industries, construction, home construction and whatnot, where you're going from one job to the next to the next. So there's a gap there. So that, we realize that number could be 5 to 1, and it still makes sense. You take into consideration service industries, again, because there's not a lot of assets there. What they do is a service. Again, you don't want to see negative equity because you want to see that business is worth something, but you're going to realize that the equity is going to be minimal because there's not a reason really to grab anything, and there's not a reason to really leave a lot of money in there. But we're not going to look at negative equity and move forward because to us it's saying, okay, you want us to take this risk, yet you're not willing to leave the money in there on your own behalf to look at that risk, and that comes to that portion. And the other the other controversial thing is, personal guarantees versus no personal guarantees. The banks, what we look at is, okay, this is a partnership we're going into. We're not an investor. That's the hard money guys. Let them invest. We're looking at, being sort of a funder, and there's a risk involved, and we're willing to put up X amount of dollars because of your profile, but we want you to be we want you to be invested in this project as much as we are, and that's usually where we require a guarantee. And after, again, the downturn of the late 2000s, the first year of the early 2000s, it's very rare now that a bank will make a loan without a guarantee. There's got to be a real compelling event or cash position or something to make us do that. And that's, from our standpoint, everyone else. Personally, I kind of agree. If the bank is willing to go and take that risk, why would we believe in you more than you would if you're not willing to guarantee? And so to me, that becomes kind of a character concern from what I'm looking at. Because, okay, if he's not willing to guarantee, then he's already got one foot out the door if something happens. We want people that are going to persevere and kind of work with us and go from there. A fifth C, if you want to add it, would be communication. I think it's important that you folks, if you have questions, that you approach the banker early on. Because in my mindset, there's only one error in a bank that can't be fixed. And that's if a teller hands out too much cash. Anything else, if we know about, we can work it through. I firmly believe that. And, the difficult time is, you've got some issues and you're having trouble making payroll, and you've just filed with your bankruptcy attorney. That's not the time to tell us. And hopefully we're getting the information ahead of time that we can head that off. But, it's not the bank's idea to collect this information just to collect it, to make it a hassle for people. Yeah. We actually do look at it and try to look at trends and say, okay, wow, this month compared to last year at this time is really down. Let's find out why. Make sure we're not, let's stem something off while it's easy to stem off. And, it's like, okay, so this gap is here. Are you going to need are you going to need a bump in this line of credit for this next period to do that? Or, wow, your cash flow is a little slow here. What's the deal? So you've got this project that's bigger than what you normally do, and so your cash position has changed. What can we do to help you mitigate that? And that does happen. Thomas had a speaker last week. It was a businessman who flat out said, banks are not your friends. And I agree with that. But we are there to help. And when we make a loan, we're as an invested partner as anyone else. So, we're not going to sit there and take back someone's house or someone's business. We don't want that. We don't know what to do with it. We take back somebody's restaurant. What, are we going to run the restaurant? That's not going to happen. Please.
wife and I are franchise coaches.
Okay.
And so we coach people through a process, whether they're military people, other clients, people out of work. We coach them through a process where we go and see what their goals, needs, and expectations are out of life.
Perfect.
And then we find and locate franchises that might work for them, okay?
Oh, neat.
So they've got to have a certain amount of cash. We've got to get them into a franchise that doesn't overextend them.
Right.
Get something that would meet their lifestyle needs and so on. When we have our clients, we would come to you with an FDD, an item number 19, a lot of different things that would help qualify them.
Okay.
Do you look at them as a startup? As for my education, do you look at them as a startup when we come to them like that? Or do you look at a franchise that somebody from the military or something could come in with differently?
You know, we look at it, it's kind of a combination of both, because we look at the franchise itself as giving you a leg up. You know, if it's a Jimmy John's or, you know, something that's established, we take that into consideration. But we also take into consideration, okay, this gentleman coming in has no experience running this. You know, he's not been in the industry. So from that standpoint, it's looked at as a startup. On that, and from my bank's position or the way I would look at it, the first thing that would trigger in my head is looking at an SBA 7A program. And why we do that is the SBA 7A program has a register of national franchises that they've done. And, you know, and we can go and check that out. We know that this is an approved franchise through them. You know, if they've got all their ducks in a row other than, you know, maybe capital's a little light or there's no value, that's what that program is for. It's to allow businesses or people that want to do businesses to get into them knowing that there is something that's preventing them from getting conventional bank financing. So that would be the first direction I would go, looking at something like that. And it's you know, Thomas and I, when we were at the bank we worked together at, I did a deal for a Dairy Queen. Yeah, same way. You know, it was a guy that ran it, but he was buying out a partner and everything like that, and it was a perfect SBA deal, and it went well. Why the bank likes it is the SBA is guaranteeing 75% of that deal, so the bank's exposure is basically 25%.
Well, I know when people look at franchises, you think of McDonald's and Burger King and all these other ones, and most of the franchises we deal with are people that are going to have an all-in of $150,000 or less, and so there's not a steep amount
Right.
of money involved. And also, you've usually got a franchise that's got a 10 to 20-year track record with other locations.
Yeah.
So all the parameters are put in place so that somebody has a good chance of succeeding. So I was just wondering.
Yeah, and that would make sense to look at, you know.
Because as I deal with you know, military here in Tacoma and other clients going forward, I'd love if they could work with local banks.
Yeah, and that would be.
That makes sense.
I think we should sit down and kind of get to do that. Sit down afterwards and maybe, you know, set up a time and go over some of that, because I think the SBA program with franchises is perfect. I think that it meets the criteria. It alleviates the bank risk, you know, at a point. There are franchises that have already got a history with the SBA of doing well. Again, it's going to come down to, you know, the character issues and your availability or the ability to operate that. And then if you have a military soldier or sailor or airman that has, you know, logistics backgrounds or things like that, they're right in line to do that. Or supply, or, you know, their background would lead to some success there. I would think the only challenge per se, and it might not be a challenge, is the people skills. But, you know, I think that program is designed for that. There's also military benefits that they get through the SBA for being military.
And there's military benefits for franchises.
Right.
They can get
Same way, right. So I think that would be the way to look at something. And, you know, if we look at SBA programs, most of the banks will do it. So that's your preference. But there are some banks, there's preferred lenders that, and the bigger banks and most of the good-sized community banks here are preferred lenders. And all that means is basically we make a decision internally and the SBA abides by it. So, once we approve it, it goes to the SBA and it moves
What kind
forward.
of closing rate do you have on SBA loans?
Closing rate meaning?
Well, number of people that come in compared to how many go out with a loan. So,
Hard to say, because a lot of them that come in are so far off that it's almost not counting them, but the application goes through and we still have to go through the process of doing it. I would say on franchises, it would be, 60% or higher on established franchises, because again, it goes through a registered board where the SBA comes back to the bank and says, yeah, we're in. And that.
And back in the old days too, back in the late 90s, the bank I used to work for, we had a niche in subways. And the brokers would come in and we would just go boom, 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 and just,
Get 'em through.
to send them through, because we understood the process, understood the
Yeah.
company and all that. However, you gotta be careful too, because then the bank gets filled up with franchise deals, and they're like, okay, we got too much exposure now.
You gotta diversify.
Yeah, we gotta.
Yeah, and that happens.
Sure.
That's one of the things. But again, the value to something like that, if they're doing it at you weren't doing it at SBA, you were probably doing it.
No, we were doing this.
Your only exposure is 25%. So that's.
Yeah, and then the beauty of it too, if the bank sells it, secured packages and Securitas and sells it on the secondary market,
Right.
They make good money off of that. Too.
Yeah.
So you gotta find a bank that's willing
And
to do
that's
that.
and that's kind of why we look at that SBA program very, very heavily on the 7A, is because there's a benefit on the back end to the bank, things that don't go. But it was pretty interesting where you talked about that. That's another reason, you can come into a bank and everything can be great, but banks are like any other investor per se. We've got buckets of money. We want to make sure the funds that we have out are divested, especially after, again, the downturn. Hopefully we've learned our lessons that banks that were heavily into real estate, they went under because they had no background.
diversity.
Yeah, so a lot of banks, and the one we do, they'll typically say, okay, we've got an appetite for X amount in this industry, real estate, C&I, and whatnot, and we try to stay tried and true to it. If the downturn, and I can speak firsthand because I worked for a bank that was heavily in real estate. The downturn on that is everyone has that plan. Oh, we're not going to go over this amount or whatnot. But then you see, that's the exact word. You see people making money at this bank going, wow, we can, I know we only wanted to do a loan to value of 75%, but Bank X is doing 80 and they're raking in money over, so let us do 80. And eventually it was like all three of the banks that were doing stuff like that are gone. And for 1 year, what always amazed me during that time was the year before the downturn, like 2005, 2006, the banks that went under were lauded for having the right model by all the investment groups that were out there saying, oh, well, how come you can't make the returns these guys are making that year? 2 years later, these guys are all out of business, and the ones that were being criticized were just chunking along at a nice 4% return or whatnot, or the ones that survived. So, there was a heavy lesson there, and for those that are talking about, that'll never happen again, it will. There's a down. That's why they're called cycles. It's going to happen. We had kind of a smaller one in the 80s, and then a real small one in the early 90s, and this big one. But, again, just straight opinion, I'm a little worried about things now, because if you see the home costs or home prices in Seattle and King County or whatnot, it looks like they're setting themselves up for another bubble.
What about the multifamily industry? I mean, they're just building all over the place.
See, I don't have a lot to do with that. I think there's in danger on that because of the larger, when you get into 150, 200 unit guys, I think there's a danger there. I think the folks that are building 24 or less, maybe fourplexes with, 8 units or whatnot, I think they're going to be fine. There's always going to be a market for those because, even in a downturn or whatnot, when investors have extra money, that's what they're looking for. They're looking for that nice. So from a bank standpoint, I would, we have a group that specializes in the large, but I think the the safer route is if you want to do the smaller deals, just because there's a secondary source to get out. And that's the third piece. That's why your personal information is important, is, we look at, okay, should something happen? So by the way, okay, we're calculating, we're going to do a rate, we're expecting it to be 5%, $100,000, 7-year term. But as I analyze it, I'm going to say, okay, interest rates are going to go up. Let's say interest rates go up 3%. Where am I? And then look at my numbers there. If we're still at the 125, we've got a deal. If not, we're looking at it and going, well, they're a little short. They're still above 1-to-1. There's a expectation that revenues and profit are going to grow here, and we factor it out. So we do project out to move forward. But as you look forward and look at what we do, it's important that the business owner have an idea too of what they want to grow. Because the worst thing the thing that kind of drives me crazy as a lender is when the owner comes in, yeah, I did last year we did $500,000 and this year we're going to do $2 million. And I'm like, yeah, how are you going to get there? Let's think this through, because that's a big jump. Or the one that bothers me even more, and it happens a lot, and I can see why, because it's human nature, is we've been making all this money and our job size is $500,000 or whatnot. We've got this opportunity to do this $2 million job and we're going to make this on it. And again, my first question is, okay, let's look at the cash flow you're going to need to support that job, because you might be taking a job that's going to put you out of business. I mean, it's great if you can do it, but let's see if we can help you. Let's see what we can do or what we need to do to help you get there. And so,
Can we talk about rates? Because I know maybe when people look at your videos, a lot of people have a misconception of why can't you fix a commercial rate for 30 years? It's only 5 to 7 years.
Yeah. Well, that's again, interest rate risk is depending on what happens. The home market, where you have your 30-year fixed mortgages, those are all packaged up and sold to some investor who's going to take it and sell it to other mortgage guys and create more of a problem. On the commercial loan side of what we do, we actually fund from your deposits. So we fund internally for the most part. We do borrow some, but because of that, people like yourselves have entrusted us with your hard-earned money. We want to make sure that there's a return for it. So we try to minimize our interest rate risk going forward too. So, if we're gonna go 10 years out, and right now that's probably the longest anyone will fix a rate is 10 years, is, we want to make sure we do our analysis as to, what our cost of money is, what we think that rate might get to versus the rate we have now. Is this a deal that makes sense that at the end of the day, using our internal funds, over that 10-year period, have we made money on that? Because it makes no sense to make, money the first 5 years and lose money the last 5. And that's the last thing we want to do. So we, as banks, try to shorten the term of the loan as much before we price to hedge against the raising risk rate environment. The advantage to that is we try to incent you to go with that, where we can use indices that keep that 5-year risk really low, keep that rate low. So, we're here, we know we're going to be fine there. If we go longer, interest rates are typically an index, a national index or international index plus a spread. We base most of our term stuff at Home Street on LIBOR. So we've got that lower rate. But, if you're looking LIBOR plus, and we're going to go 5 years, we're probably going to look at a spread of maybe 2.5%. We'd be comfortable if we can go there. But if you're going to go 10 years, that rate is already a little bit higher, but we're going to increase our spread also to try to go there. So you'll see, 5-year rates that'll be 3, right now probably 3.8, 3.9, below 4. And you'll see 10-year rates up in, I've seen some banks go low, but most of those banks are going to be approaching 5 or 6 because, again, you can't predict the future and you want to make sure. I think it's important for a customer to talk to the bank and make sure the bank is what they expect. Again, because you don't want to pay fees for services you're not using. I think, everybody's money is green. The value that the bank can give, especially a smaller end bank, is the attention and service that they can provide you. Like I said, I like to get involved as much as I can, not because I'm nosy, but I want to help folks reach their goal. It's great for us to make the loan. It's even greater to see, 10 years down the road where Jim started out in a leased 15,000 square foot building, and now he owns a 30,000 square foot building that he's set up for leasing for retirement and stuff like that. That's where we feel good.
Yeah, I could probably concur with that with Frank, because it's, as a banker, we get performance evaluations, and they look at our portfolios and all that kind of stuff. And if it's everybody's doing great, that means that not a lot of charge-offs on your clients. That's a good feeling. But the best feeling is like when you start with, as an example, when I had a flying school that started at the peak of the recession. He comes to me because I want to start a flying school. I was like, what, are you nuts? But he had a great concept, had a great idea, and now he's one of the best flying schools in the Puget Sound. 14 pilots, and he just knew the market, and I'm going, man, it's...
Plus, he's doing one other thing that, again, that kind of illustrates what we've talked about a little bit. He does single engine. All that competition is in jets. So he's staying out of all that noise, and he's becoming the best single engine flight school that there is. And he's not having to deal with this competitor, that competitor. He's the big game in town, and he's comfortable doing that. He says we can do jets if they want to come and do that, but we'll have a simulator, we'll lease the plane and do other things. But I'm not putting my money into that basket. This is where we're successful. And like Thomas said, we're looking at a deal where, right now he's leasing a few planes. We're working with him. Again, part of the service that we're doing is, okay, he's planning to build his corporate office and new hangar facility in 2019. And we've kind of estimated, and we've gone through, what the cost will be, what he's looking for. So we're already working on it. So we've got a couple deals with him now, and each month or quarter we look at his financials and we'll say, Gordon, here's what you need when we get to 2019 you want to build. You're going to have cash of X, $3,000, let's say $300,000 if it's $3 million. We want to work with you to make sure you're going to get there, because when 2019 comes, we want to position you to the point where you're ready to go. And I think from our standpoint, we take the time out to do that from a smaller bank. I don't know if a big bank would do that, because it's so transactional, and that's why it's important. If you're looking for the best rate and you don't care about the service or whatnot, hey, the big bank is a place to go, because you'll do it, they won't bother you, it's whatnot. If you're looking for a trusted advisor or someone to work with, or a good relationship in a bank, I think the community banks, such as ourselves and the Heritages and Columbia's getting a little big, but the Columbias of the world, that's the kind of bank, because those are the bankers that are going to sit down and talk with you at least once a quarter and say, hey, my biggest thing in banking was, it really bothered me that people thought every time I called it was bad news. And that's the perception that bankers have. Well, am I overdrawn? What's going on?
What I do.
Right. And so I used to make it a habit. I don't want to be that. I'm just going to call folks and ask how they're doing, so they get used to, it's not bad news. I'm just interested in seeing what I can do to help. And so it's changed some. Our reputation, Thomas and I, has kind of been, we're your non-traditional bankers, that we don't act like bankers. I don't know if it's a compliment or a criticism, but it seems to work.
Anyway, the time's up.
Yeah,
so-
do we have any questions? specifics or anything,
it's,
Presentation, Frank.
Yeah.
like I said, sometimes, when you come here, it's a hit and miss type of situation, I think banking is really important, that everybody understands and develop the relationship with the bankers, and it's not all the same. Hopefully the potential entrepreneurs or
Yeah, the industry is changing. You'll see the commercial bankers, the newer ones, they don't do their analysis. I think the analysis is shipped somewhere where the underwriting is done now. At the smaller banks, like ours, we still do our underwriting, and which I like. I mean, I don't see how you can learn someone's business without doing the underwriting and doing it. And so I think that's where the community banks, I think that's where we can bring value because we take the time to do our own underwriting and whatnot.
And that's a good point too, what Frank just said, you know, it's, bankers don't want to know your business, they want to understand your business, you know. They don't want to get in the nitty-gritty of it, they just need to understand what the heck's going on, that's all it is.
A banker should never tell you how to run your business. If we knew how to run your business, that's what we'd be doing. But we can make suggestions as to maybe how to collect your receivables quicker, or how to take advantage of this program. So, you know, did you realize that if you paid within 10 days, you'd get a, 2% rebate, and this is what the calculation is? Or do you realize by paying that 2% rebate, you're doing this, you're costing yourself money on the back end? Or, because I've seen one person saying they're taking advantage of discounts. Well, when we calculated it out, that discount was costing them, their effective borrowing rate was like 30%. It's like, yeah, this discount isn't working for you.
So, anyway, well, hopefully you guys will.
Yeah, if you have
More.
questions,
Yeah,
Thomas has my info, or if you want a card, it doesn't have to be specific, it can be general, but.
Do you ever do 401ks, rollovers for people to get started in a business?
We have a group that does that internally. I can't because I'm not licensed. There's a specific licenses and whatnot that, yeah, there's specific licenses and classes that you have, accreditations you need to do it, and I don't have it, but we do have, most banks have groups within that do it. And I think ours is, again, where small banks come into consideration is that we're not sophisticated or smart enough to know to charge you for everything. We only charge you for, what makes sense. We realize people work hard for their money. Just as a side from our standpoint, we realize that as I've got a customer that was with the big bank, had on deposit because it was a property manager, about $8 million total. I mean, that's a large sum of money. Yet they were still paying about $2,500 a month in service fees for the services they were using. So we looked at it. I think the earnings credit that the bank they were at was 0.2. And we're not saying anything, but ours has been at 1% since the downturn. It's going to remain there. So when all was said and done, they were being able to do the same things that they always did, and it didn't cost them a cent. And $2,500. That's a nice chunk of change at the bottom line at the end of the year. And so, we realize that there is value. We've been blessed enough to get your money to use to lend out and make it returned. Why would we gouge you even more? Greedy, like you said. That's the word, greedy. That's a whole different issue.
Well, thank you, guys.
Thank you.